one. But if you have more than one unknown number, this is obviously not going to work. And here comes then the next step, which is pretty easy. If you have more than one, then what you need to use is the so-called expected standalone price. Now, what is the expected standalone price? You take the cost. Do you know the cost? Yes. Well, most probably you will know the cost. And you add the probable profit margin. Okay. Was that hard? No, that was actually a mathematical trick. Of course, I do realize that you guys are after lunch, which was a huge mistake. Because right now, all the blood will go to the stomach, right? So you have to struggle to get it back to the brain. Now, anyhow, we understood that this is how we are going to deal with the issues. There is one more rule that we need to understand. Transaction price is not reallocated subsequently the change in the standalone prices. Okay? So once we calculated how much is the standalone price is going to stay as is. Even though if they are changing later, even though if they are changing materially. Yes, why? Because when I made the contract, I already made my decision based on that. Okay, so regarding step 4, what is new in the IFRS? Honestly, step 4, I repeat, is the easiest. Transaction price generally allocated to each separate performance obligation in proportion to the standalone selling price. Okay? Did we have this rule before?
No.
No, why? Simply because IAS 18 did not deal with situations when they are having multiple deliverables or performance obligations. However, did we do that? Well, in most of the cases, yes, we did. Right? Most of the cases, this is what we done because that was the most obvious solution to the problem. Now, specific requirements are going to be provided for allocation of discounts and variable consideration, and when standalone selling price is not observable, then we will estimate the standalone selling price. Please put over here, I didn't dare print it because then you are going to come after me and say that I said it. But there are two possible ways. One of them is the residual approach. And the other one is the so-called, not residual, but the markup. Okay, what is markup? Take the cost, add margin, that's your selling price if you do not sell it separately. Alright? Because sometimes you simply do not sell it separately. Okay, now let's see what is the change from the current IFRS. Well, currently we don't have a rule how to split this up. And to be honest, the allocation process in IFRS 15 may be very similar what we are currently doing. Why? Simply because that's a very straightforward way to allocate the transaction price. Okay. Now, as I told you, use of the relative selling price is a pretty new idea. I mean, a new idea in writing, but this one we were using a lot. I already told you what is on these two slides, so if you don't have the relative selling price, what are we going to do? Either use the residual approach or simply try to use the markup method. So basically I'm just simply skipping these two slides and let's go immediately to the case study. An entity enters into a contract with a customer to sell products A, B, and C for 100. The entity will satisfy the performance obligation for each of the products at different points in time. Okay, what does this mean? So basically I am making a package deal with you and I'm actually delivering this plus this plus this, but on 3 different days. Okay? Now how am I going to say out of the 100 what belongs where? Now, they regularly sell product A separately and therefore the standalone selling price is directly observable. So there is no problem with that one, right? I just see how much did I sell it for in a market when I'm not bundling together these products. And then the next thing, that the standalone selling prices of product B and C are not directly observable. Okay, why? Maybe because I'm not selling them separately. Because the standalone selling prices for product B and C are not directly observable, the entity must estimate them. And what we are going to do? Well, we will see where can I do a markup and where can I do a residual. Hold on for a second. When can you do the markup? When can you do the markup type of situation? When can you do the markup type of calculation? That's important.
When you can identify the
When actually you can prove that there are similar products, similar to B or C, which are actually sold separately, and you can at least estimate a markup. Right? Okay, what are you doing if you don't have a possibility to calculate the markup percentage? Once again, good luck. Okay? Because the standard doesn't allow you to take the two for practice. There was actually a version of the standard where they wanted to put together all the items that are not observable one by one, and they said that take them as one and treat them as a residual price. Now, this sentence is not included in the final standard. Okay? So therefore, you must try to assess. What if you are unable to?
Good luck.
No, well, that was the good luck part. You were trying to do it already. What is going to be the solution here? Actually, there is one. If everything else fails, you wait until you actually get the last dollar. And you defer the revenue to the last minute. But that's only when everything else fails. Do you want to do that? No, you don't want to do that. Right? Why? Because it is not going to be, nobody's going to like you. Right? The board is not going to like you. And so you will have to try to make your efforts. When do you have the real problem? When there are more than one items where you have to calculate, right? Because then the split, can you do 50-50? Nah. Can you do it based on their cost, relative cost? Probably no, because that's prohibited. Okay? Actually, that looks like a realistic idea to use the cost as a split of point, but that is actually prohibited. Unless you can prove that the prices are in line with that. Okay? Now, so what we done? Look, we done the ABC, and we see this was directly observable. Here we used an adjusted market assessment approach. Okay, what is this second method? What is this second method? What the second one?
Like
Adjusted market assessment approach. It looks very scientific.
Similar product.
Yes, that's
discount
it.
But,
No, you don't discount anything. It's just a similar product, and you try to adjust what is the difference between the two, okay? And then the third one is expected cost plus the margin approach. This is when you don't even have a similar product. So are you allowed to use similar products? Yes. And you know where are we doing this a lot? In telecommunication. I tell you why we do that. For instance, how much is the selling price of a single SMS? A message. Right? Just take a look at the packages. They are going to be totally different. And currently, the worst package of all is which one? Where you have unlimited of everything. I don't know if you have it over here, but that's a nightmare in revenue recognition. Because what you do is you sell a handset. What is a handset? A telephone. With a loss, usually. Right? They kind of like sell you an iPhone for $1 or something. I don't know if you have these deals here. But they sell it for a very, very low price. And then they sell you with unlimited usage. Only there is one thing what you need to do is pay $3,000 a month for the subscription, which is not cancelable for the next 12 months. Right? 12 months. Now, in this case, what do I need to do? I need to allocate between the phone. Hold on, I sold it for $1. And I did not sell it for $1. Of course, I sold it for the next 12 revenue. So how will I know how much is going to be the value of the iPhone within the package? Market, right? Well, you don't even have to do the market because usually you sell those phones individually. How do you know how much is going to be the subscription? Now that can be market, right? Because this one, if somebody is selling without these limitations, that can be assessed. And how are you going to know how much is going to be, I don't know, the data and the SMS? Well, for that one also the market price is going to be available. But for instance, if you are selling news messages, you know what is a news message? Yeah, I mean, let's say that you're the only one in the country who is doing that. Well, I happen to be, I'm lucky enough to be the auditor of the one who is having this news SMS, and they are the only ones who are doing it in a very small country, which is Hungary. So we need to allocate a price to this. How do we do that? How we say that the cost of it is approximately this much, and actually it's 20% of the margin. How do we know the margin? Because it's always like 20%. What was this last one? This was the cost plus. And then let's assume that I'm selling something else, and it's so out of the context that there is just no way assessing anything about it. What are you going to do with it? Leftover. But the leftover is your last resort. And what about the resort? After the last resort, I already told you that. What's the last? Differential. You receive it. Where do you see it in the standard? Nowhere. That last one you know it. You don't see it anywhere. Okay? But that is the final conclusion, that if you don't have a chance to calculate, then you have to wait until it becomes obvious. Now, so what did I do? Look, 50, 25, 7. Hold on, it's altogether 150. How come? Okay, because I sold in a package, so most probably I give a decent discount. Well, it's a very decent discount, right? It's for 100, what I sold, whatever I'm able to sell for 150. And what am I going to do? Right? I mean, that's not a big question. I just simply do the mathematics, but I made a mistake in the mathematics. Where? That should be 150. Okay? Right? Because altogether, how much is that I'm selling? 150, right? Out of the 150, this is 50. Out of the 150, it is 25. Out of the 150, it is 75. And I take the currency units accordingly. Now, is this going to be a huge problem? No. Step 4 is easy if you talk about the mechanics. What is the hard part? Estimating the, what was the name? Standalone prices. What is the standalone prices? If they are sold separately. What's the problem? Some items are never sold. Okay, and then we have a problem. Okay.
That's a question here.
Yeah.
This question was asked earlier about the POC percentage. So can we give a different POC percentage to each?
Yes, if it's but that's not a question of the transaction price. Now let's assume that this product is something what you give. This is also something what you just give, and this is something what you actually do. I mean, after you gave these to the client, you transfer those, and then you promise that now I'm going to make services to these assets. Like I'm giving you this telephone center, I'm giving you this building, or this other asset, I don't know what, and then I will start service this asset for you for a year or for 2 years. Understand what I'm saying? So I'm selling you something and then I'm operating it. This is going to be, we will see it step 5, point in time. This is going to be over the time. So this is going to be accounted for whenever risk is transferred or whenever my performance obligation is fulfilled. And this one is going to be recognized as I am providing the services. So actually, don't get confused. Splitting the number into parts does not mean that I will have the same accounting treatment to each and every one of those, right? Some of it may be point, some of it may be over the time, okay, depending on what is the provided service or good.
Let's see, just a quick one. Let's say, for example, product C has been subcontracted in the sense that we are selling it as a
product C
subcontracted. For
Subcontractor, yeah.
We are selling it at 100, but that product C we have purchased it, or we are asking somebody else to do it on behalf of us. So do you add that margin? What about, or you just take that as a?
No. I understand what you are saying. That's actually something what is not included in IFRS 15, but we have an idea about it. So even though if you are purchasing somebody to do it for you, is it reasonable to say that you are going to do it for free, to integrate the service? No. So you are, if you are business practice to add margin to something, then you are going to add margin. Okay? I mean, if you don't add margin, you basically misunderstood something, the business. Okay? Good. Now, let's go further and let's see this very easy example in the next one. I am just going to quickly walk through this because this is basically very simple. Manufacturing corporation entered into a contract with a customer to sell a machine for $100,000. The total contract price included installation of the machine and a 2-year extended warranty. Assume that manufacturing corporation determined that there were 3 distinct performance obligations and the standalone selling prices were as follows. See that? 75 would be the machine. If they ordered only the installation, it would be 14. And what about the extended warranty? If they would purchase it separately, this would be 20,000. Okay? Now, hold on for a second. How did they split this into 3 pieces? How did they split this? First, they needed to see if they are distinct performance obligations. Let's very quickly revise. What is distinct performance obligation? Capable of being distinct and? Contract. And from the contract, it's obvious that it is going to be distinct. Now, so what did I do? I basically give 9,000 discount. You see that? Why? Because if I add these guys together, it's 109 and I'm only giving 100. I'm only asking for 100. Why did I ask for 100? Because you purchased all the 3 with me, right? I don't have to market it or anything else, right? So therefore, is it logical? Is it reflecting the commercial substance? Yeah, most probably it is. So what are you going to do? You are going to do what? Split according to the standalone selling prices, which is 75, 14, and 20. So basically, this is what you guys are going to do. You take actually only the portion. This is the same way how you allocate discounts. All right? Surprising? No, not. Step number 4 is easy, as I told you before. All right? Now, we have like 3 more examples of this. So I am not going to go and do all the 3 examples. If you want to do it at home, you can do it. It's simply a mathematical exercise. All right? Hold on. There is, however, one more thing I want you to tell me. You remember the example which was happening at around 10 o'clock? When we had the machine? No. Honestly, it's not that far away in time. You had the machine, you had the installation, which could not be separated. That was one performance obligation. Right? And that was the other one. Okay? Now, how are you going to split the amount? Are you going to use 3 numbers or only 2 numbers? Only 2. So it's not the standalone price of each and every item, but it's the standalone price for each and every performance obligation. And you remember, the performance obligations in the previous example, the machine, installation, and service, every 3 of it, each and every one of it was capable of being distinct, right? They just haven't been distinct because of the contract. Even though that I can observe the distinct selling price of each, I'm not using it, right? Why? Because from the perspective of the contract, I only have 2 prices, all right? That's easy. And now comes the big fight. Step number 5. It's not going to be hard to understand. I just feel like clients sometimes do not want to understand. Because that's the big question. Can I recognize the revenue before I complete it? So can I use the old method which is called POC, or do I have to wait until everything is finished? Okay? Now, which is the method that I need to apply? Now, please remember, it's extremely obvious in the standard that every revenue must be recognized at the point of time. So that's the default. Okay, translate from English to English. When the service is done, but like done. Okay? Good. Except if you can prove that one of the following 3 criteria is met. Okay, let's see what are the 3 criteria. Well, actually, it looks like we have 7, but don't worry. The entity creates or enhances an asset that the customer controls as it is created or enhanced. Read it again. So, you kind of work on something which is not yours. Okay? Now hold on for a second. Tell me which standard was that previously. It's IAS 11. That's the construction contract, basically. When you are actually building it for somebody else. Alright? Now. Or what is the next one? The entity performance does not create an asset with an alternative use. Okay. So only who can use it? The person whom I'm building it for, whom I'm making it for, or whom I'm providing it for. Tell me a tip. There is an end. I know that there is an end. I will finish the sentence. But tell me an example first. Tell me an example which satisfies this performance thing. Like you provide consultancy service to somebody. Is it like, can anybody else use it? No. And here comes the catch, because that one is easy to prove. There are some situations, I mean, this situation is easy to see. If somebody else can use that asset or not, okay? And the entity has an enforceable right to payment for the performance completed to date. Which means that if we stop working together, you need to pay me at least until the percentage of completion. If you are not, then it's going to be recognized when actually the deal is closed. Okay? Now. And let's see what is the last one. The last one is easy. Actually, the last one is easy. The customer is simultaneously receiving and consuming the benefits of the entity's performance as the entity performs, right? And another entity would not have to re-perform the work completed to date. Okay? For typical example, if I am telling you that I am going to clean your offices, right? And you are going to pay only monthly. You are going to pay at the end of the year. Can I recognize the revenue over the time, or do I need to wait until the contract finishes? No, of course I can do what?
During the time.
Because why? Because when I provide a service, you immediately consume it. So basically they assume that this is going to happen, right? Okay? Because there is another person who will come and fill in for you, will be not required to re-perform the work. Why? Because it's already been done. Right? So, if any of the three situations happens, it may be over the time, so the old POC method. So this is going to be the old POC. So, here is it with words. I am creating or enhancing an asset, right? And look back to here. Look back to here. You don't go back, I go back only. How many criteria did I have over here? 3. I told you that this one and this one are basically separate. Yes, they are, but if somebody is consuming simultaneously the benefits, can anybody else use it? No, because immediately when I provided it, you consumed it. It's like if you cut my hair, nobody else is going to be able, well, obviously, right? So the standard is telling you that the entity does not create an asset with an alternative use, and at least one of the following is met. So basically, instead of having 3 criteria, the standard is listing 2, but at the end of the day, it's going to be obviously 3. Okay? So, the entity does not create an asset with an alternative use, and at least one of the following is met. Continuous or simultaneously receives and consumes. First one, an entity would not need to substantially re-perform the work completed to date. And if this is true, that is going to be true. The entity has a right to payment for performance to date and expects to fulfill the contract. Okay? So this is the official type of rule, but actually it is all can be organized in the 3 big categories that I mentioned on the diagram. Okay? So this one you need to understand very carefully. Why? Because if any of these are true, you will recognize the revenue when? During the time. So you can bring it forward. Okay? Now, let's see how are we going to be able to measure progress towards completion. So how do we calculate POC? I'm going to be totally honest with you. This part of the standard is not very clear. It's clear, but they don't tell you how to deal with it. You have two methods. So a single method for a particular performance obligation. So you can change from PO to PO, the method, but it must be consistent. The output method and the input method. Tell me, what is the input method? We had this previously. What is the input method?
Cost.
Basically the cost versus to the cost which is expected to be totally spent, right? So the old POC method. They actually introduced something, okay, as a professor at the university, I think it's scientifically very nice. However, as an auditor in practice, I just don't have a clue how are you going to calculate that. The output method. Let me tell you what is that. You are measuring your revenue based on how much did the client enjoy from your services. So you are grabbing the revenue from which point of view? From the customer's point of view. So it means that you need to transfer yourself into the customer.
Can I add something?
Yeah?
Just to if I see it from my industry's perspective, like construction industry, then output might mean the physical progress. The physical progress is something which is measured monthly, and it is the result of those input activities which you are doing monthly, and at the end of it all you have some progress, physical progress.
Okay, so you say that you ask for a surveyor.
Yeah, and there is a surveyor, and for my industry, there is a regular daily basis, sometimes weekly, sometimes monthly is must.
Okay. Let me tell you something here. This is not what the output method means. That's also an input method. Because the surveyor is going to work how? They will see how much work was actually performed, maybe not in dollar terms, but it is going to be expressed how?
Quantity.
Yes, in quantity. And just one more thing regarding your industry. I'm auditing a lot of these construction things. And to be honest, if I see a surveyor, I try to chase him away, at least away from the books. And the reason for that is, because usually a surveyor is, look, when do they think that the building is ready? If they see a foundation, and if they see the four walls, and the roof, what are they going to say? Oh, it is happening. And we all know, yeah, from the construction point of view, that's a building which is almost ready. But if you are not selling core and shell, I don't know if you know this expression, what is core and shell? When it's only the walls, right, and nothing inside. Maybe the cords are inside, but no nothing inside. Then maybe it's going to be an okay approach. But if you have ever seen the construction industry from inside, what is the most expensive part? Yeah, putting the wallpaper and putting this costs the most, right? So if you do the surveyor, you are using an input method which is, I think, biased. Why? Because they will say that you are ready with most of your things when? Before you start decorating, and then you will realize that you are making losses. All right? So that is going to be an input method, but from a different perspective. Output is how the other party feels that the contract was.
So how much they certified already?
No, not that. It's how do they feel that how much did you perform? So and this is the reason why I'm saying that it's impossible to understand how to measure this in reality. So this one is not an approach that is basically doable, in my understanding. Okay? Yeah? Now, all right. There is one more thing that you need to remember, and it's not on the slide, so please make a slide note on this. If I have a performance obligation that is fulfilled over the time. If it's over the time, and I cannot calculate the POC, so I don't know where am I at, how much revenue I'm recognizing. The rule is the following. Rule number 1, none. Which means that all the costing here are going to do what? Give me a nice loss. Right? No. Give you a nice loss. No revenue. Only you can recognize a